In this video, we're going to talk about second mortgages and can they save the Canadian real estate market. But before we get into it, do me a favor. If you're liking what you see, don't forget to hit that like and subscribe button so you don't miss any future videos from me. Okay, let's get into this. Second mortgages. Can they save the real estate market? We've seen an aggressive rate tightening cycle by the Bank of Canada. Rates have gotten so high over the last 18 months, Snoop Dogg would be blushing right now. So what does that mean for most people with mortgages? It means their payments have dramatically increased. Either they've had a variable rate mortgage where their payment has started to go up consistently over the past year and a half, or they've had to renew their mortgage and they've been enjoying a low rate fixed payment for the last 5 years, and now they're renewing from a 2% rate into a 6, 7, sometimes even 8% rate depending on the situation. That means people's mortgage payments have increased dramatically. And unfortunately, for a lot of people, they can't keep up with those higher payments. So what are we supposed to do in those situations where people are struggling? A word of caution. Before we start talking about second mortgages, my opinion is if you're struggling to make your first mortgage payments because of how high the interest has gone up on you, your first option needs to be to sell. That's number one. But now that we've gotten that out of the way, if you're not ready to sell, or you're in a situation where you need a temporary fix and that you know in 5, 6, 7 months, your situation will change dramatically and you just need a stopgap. You just need a Band-Aid, a little bridge to get you from right here to 6 months down the road, then a second mortgage might be your best solution. So what is a second mortgage? And it's exactly what it sounds like. You currently have a first mortgage with your bank, which could be a TD mortgage, an RBC mortgage, an MCAP, a First National, doesn't really matter who it is, but they're in first position, meaning they registered their mortgage a few years ago, they're in first position. If anything were to happen to the property and they have to sell it under a power of sale, they get paid first. So your best option in terms of getting a second mortgage is going back to your existing lender and finding out if they are able to give you additional money as a second mortgage. And the second mortgage can be in the form of a home equity line of credit, meaning they can register a second mortgage and give you a HELOC behind your current first mortgage for $50,000, $60,000, $70,000, whatever you qualify for. And that's the cheapest form of money you can get right now. And typically that's going to be at prime to prime plus a half. So anywhere from 7.2 to 7.7, depending on your situation. And it's going to be revolving credit, so you can pay it down and reuse it again in the future. But what happens if you don't qualify with your bank? What happens if you go and apply to them and they say, unfortunately, because of your credit, because of your income, you don't qualify for a HELOC right now. So what are your options at that point? There's alternative lenders that we can look at. They provide something similar to a HELOC. They call these equity Visa or equity MasterCard programs, where they have much higher debt to income ratios than banks do. They make it way easier to qualify if your credit or an income is an issue. So we can look at those solutions too. If those solutions don't work out, there's other lenders that we can look at who offer home equity loans also as a second mortgage, and they can be relatively inexpensive as well. They can be rates starting from $599, $699, $799. They do charge administrative fees, so when you factor those fees in, the rate tends to be in the more to 11 to the 15% range. But they can get you the money in 48 to 72 hours, and it can be lightning fast. If you don't qualify with those alternative lenders, then there's also private lenders who will consider lending you the money. Now, private lenders, they're going to be more expensive than the banks. They're going to be more expensive than these alternative lenders. For second mortgages, they can be 11 to 15%. Plus, there's going to be administrative fees. There's going to be lender fees. There's going to be broker fees. There's going to be legal fees. So prepare yourself for these additional costs that you're going to incur by getting a second mortgage with a private lender. Typically, the private lenders are not so much concerned about the ability to afford the mortgage. They're more concerned about the equity available in your home. So you have to have a good chunk of equity to be able to get approved with these private lenders. But before you jump into private lending, we also need to know, what's your exit strategy? How are we going to be able to get you out of this private loan? Because it's easy to get you into a private mortgage. The trickier part is getting you out. What's the exit plan? Are we going to be able to rehabilitate your credit? Is your income situation, is that temporary? Were you recently laid off and now you're in the process of looking for a new job? And you know you're a professional, you'll land on your feet somewhere making good income. And if that's the case, then maybe it makes sense to move forward. But if you're laid off and you're going to be in a lower income paying position, and we know in a year's time, you're still not going to qualify with a bank to redo everything into one, then maybe second mortgages aren't your best option. And what we're seeing right now is a lot more people taking on second mortgages to help them cover their first mortgage payments, like I said at the beginning. So there's options available to help people get the money to assist them with their first mortgage payments. And so we're not seeing a lot of people having to sell their houses right now, because we are seeing band-aid situations where people are borrowing more money to help with their first mortgage payment. But that's not a long-term strategy. Once that year is up, then what happens? Because there's probably not going to be any more equity left to do this process again. So at that point, people are going to have to sell their homes. In the next 6 to 12 months, we're probably going to be seeing a lot more inventory hitting the marketplace. And what happens when more inventory hits the marketplace? It means prices are going to come down. Will that cause a crash? Probably not. There's still a lot of people out there who are looking for properties, who do have strong incomes, who can afford these higher mortgages and higher priced homes in the Toronto region. But will it cause a crash? I don't think it will. Will it save people from losing their homes? Maybe. It gives them a little bit more time to plan and prepare for what they need to do. But at the end of the day, there's going to be more homes coming into the market. I don't think it's going to cause a crash. I don't think we're going to see an influx of power of sales. There's definitely going to be more of people who aren't able to make their mortgage payments, or lenders, private lenders who decide not to renew the mortgage, and now these borrowers have nowhere else to go. What will save the real estate market from a crash is lower interest rates. And as of this recording, we're probably going to see rate cuts in the earlier half of 2024. And when rates start to come down, more buyers will be able to purchase properties. More buyers will be able to qualify for those properties. So at that point, all these people who are going to be listing, we're going to have more buyers who can qualify for these homes. So it's not going to cause the crash that everyone's thinking of, nor will second mortgages save this real estate market either, because second mortgages are just a temporary fix to a problem. So guys, I hope you enjoyed that video. Again, if you like what you saw, hit that like and subscribe button, and I'll make sure to keep making more useful information for the Canadian real estate and mortgage market.